Ladies and gentlemen, good day and welcome to Firstsource Solutions Limited Q3FY22 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankur Maheshwari, Investor Relations. Thank you, and over to you, Mr. Maheshwari.
Thanks, Neera. Welcome, everyone, and thank you for joining us for the quarter ended December 31st, 2021 earnings call for Firstsource. On this call, Vipul Khanna, MD and CEO, and Dinesh Jain, CFO, will provide an overview of company's performance, followed by Q&A. Do note that these results, the fact sheet, and the presentation have been emailed to you, and you can also view this on the website www.firstsource.com. Before we begin the call, please note that some of the matters we will discuss on this call, including our business outlook, are forward-looking and as such are subject to known and unknown risks. These uncertainties and risks are included, but not limited to what we have mentioned in the prospectus filed with SEBI and subsequent annual reports that are available on our website. With that said, I now turn the call over to Mr. Vipul Khanna.
Thanks, Ankur. Good afternoon, everyone, and thank you for joining us today. Welcome. I hope the new year has started on a good note and you and your families continue to be safe and healthy. Here is a quick snapshot of the quarter gone by. Revenues grew 4.9% year-on-year in constant currency and came in at INR 14,638 million or $195.4 million. Of this, approximately 4% is the contribution from the recent acquisitions of Stonehill and American Recovery Services Inc. Operating margins were 12% and EPS grew by 11.6% year-on-year. When we spoke in November, we mentioned that Q3 would be a muted quarter and that we anticipated revenue growth from Q4. Unfortunately, during the past couple of months, several factors have impacted Q3 revenues and delayed our growth trajectory. The resurgence of COVID pandemic across geographies has spiked up staff absenteeism, especially in the onshore markets, impacting fulfillment. This has also further delayed the anticipated growth in our provider business as hospitals again prioritize COVID treatments and consumers defer elective procedures further. Additionally, a change in the timing and quantum of interest rate hike and the more aggressive tapering of mortgage-backed securities purchases by the Federal Reserve is leading to a sharper than anticipated decline in the mortgage origination volumes. Considering these macro factors and the supply side challenges, we are revising our FY22 revenue guidance to 14 to 14.5%, including acquisitions. The acquisitions should contribute approximately 4% to the revenue growth for the year. Margins should be in the range of 11.8 to 12%, modestly impacted by the talent situation and the acquisitions. While I'm disappointed that we are lowering our revenue guidance for FY22, I remain confident that we are strategically on the right track and that we have put in place the building blocks for strong, sustained growth for the future. Let's dive into the industry segment performance. Our banking and financial services segment was flat year-on-year and shrunk by 2% in constant currency in Q3 FY22. Let's talk mortgages first. As you know, this business comprises of origination and servicing segments. The interest rate volatility, Fed's commentary on inflation, and the likely interest rate increases in the calendar 22 have all led to a sharper than anticipated decline in the origination market. 30-year mortgage rates are already near pre-COVID highs in March 20 and have risen sharply from what we saw in November, December. Our clients are actively rebalancing their capacities to align with the reduced refinance volumes. The impact is greater on our onshore portfolio versus offshore. We expect the recalibration of the refi market to carry into the next fiscal. The servicing segment remains solid and we continue to expand our servicing capabilities and offerings. We have increased our focus on developing digital solutions for the cost efficiency needs of our mortgage clients. And we added 3 new clients in this quarter across both servicing and origination. We also recently launched the next version of our post-closing platform in the market. This version reduces the backlog of closed files significantly by identifying the gaps much faster. We are pleased with the market traction of this offering thus far. The integration of Stonehill is progressing as per plan. We are excited to take their capabilities to our existing clients and our capabilities to theirs. Coming to collections, last quarter, we spoke about the record low delinquencies and charge-off rates in the credit card industry. While delinquencies remain near those record lows, the credit card spending continues to rise and is beginning to trend towards pre-COVID levels. With the revival in spending and the impact of financial stimulus waning, the market expects delinquencies to rise over the next 3 to 6 months. So while our Q3 revenues remained muted, we are seeing green shoots of recovery. In some parts of our portfolio, the debt placement volumes are beginning to rise. In this quarter, we completed the acquisition of American Recovery Services Inc., or ARSI, a leading player in the legal network collections market. This company adds complementary capabilities, strengthens our digital portfolio, expands our client base, including few fintechs, and helps hedge against the near-term default cycle volatility. We believe that the acquisition of ARSI will significantly bolster our market positioning in collections. I'll talk a little bit more about this in a minute. As we look ahead, we are very optimistic about the collection business. It hit an air pocket this year from the unique macro environment, but the fundamentals of this industry remain quite strong, and we expect a revival of volumes in the next fiscal. Our sales effort continued to generate results. In this quarter, we added 2 new clients in the collections business, including one fintech or a BNPL company. For the UK BFS segment, last quarter, we spoke about the unfulfilled demand due to talent shortage. We have managed to address a majority of those challenges by increasing our hiring reach and opening new satellite centers in the UK. Clients continue to focus on scaling operations onshore, but are now more receptive to nearshore or offshore delivery markets. Some of these discussions are progressing well. However, as the COVID cases rose, we saw higher absenteeism even in the work-from-home teams, impacting client fulfillment. Let me switch to healthcare. The healthcare segment grew by 28.4% year-on-year and 26.6% in constant currency this quarter, and was the fastest growing segment once again. Our health plan and health services, or HPHS business, continues to make solid strides. We spoke of the large BPaaS deal with a leading health insurance company. The go-live went as per plan, and the first batch of knowledge transition has started. The pipeline for HPHS remains strong, especially in the digital intake business. The focus is now on strong execution. We are very pleased with the continued strong progress of the HPHS business. In the provider business, the resurgence of COVID has further delayed our anticipated growth, impacting volumes and our ability to staff capacity on-site at hospitals. This staffing issue is further exacerbated by the recent Fed rule requiring the staff at hospitals and health systems and their partners to be fully vaccinated. If we step back and take in the macro view, the hospital financials have been significantly impacted by the successive COVID waves. A recent study by the American Hospital Association and Kaufman Hall and Associates estimated that U.S. hospitals lost more than $50 billion of net income in 2021, despite the significant government support. Keep in mind, fewer medical procedures and disruption to a hospital's normal revenue cycle directly impact the volume flow to us. Assuming that Omicron is the last of the big disruptive COVID wave and that the public health emergency program is consequently wound down, we are cautiously optimistic on the return to normalcy and revival of volumes in the coming year. Lastly, our efforts to extend the patient continuum into pharma and med devices market is yielding encouraging results. We've created a digital beachhead and added 2 clients this year. And as we speak, we are working through a decent pipeline for the pharma and medtech segment, or med device segment, I should say. On communications, media, and tech segment, this segment continued to perform well. In Q3FY22, the segment grew by 2% year-on-year, but degrew by 1.7% in constant currency. Similar to the UK BFS, we have resolved most of the hiring challenges from our prior update by expanding the hiring reach and by moving some lines of work offshore. However, higher than anticipated absenteeism due to the COVID wave has hit this segment as well. Given the circumstances, we believe that the business has performed reasonably well and remains on a steady growth path. I'm currently in the UK and had a very good meeting with our largest client earlier in the week. The relationship remains very strong and we continue to explore new growth opportunities together. Our sharp focus on scaling our footprint in the tech industry is playing out nicely. We added 3 new clients this quarter in the fintech space, including our first crypto client, and expanded to risk management services to these clients. The pipeline is building nicely and is currently at the high point for the year. Let me give you a little bit more detail on the acquisition of American Recovery Services, Inc., or ARSI. It's a leading player in the legal network collections market. ARSI was founded in 1986, providing legal collection services nationwide to the leading credit card issuers, insurance, and fintech companies. The firm over the years has developed a strong partner network of attorney firms across the 50 states in the US to help provide legal action to resolve uncollected debt in their respective jurisdictions. Let me just take a minute and explain the high-level debt collection value chain. Once a borrower defaults or charges off, creditors have largely 3 options. 1, they could call and collect, which is what we do today, which is recover outstanding dues by call or digital strategies. The second is debt sale, where you sell the debt portfolio to a debt buyer for a percentage of the outstanding balance, so cents to a dollar, and then whatever the debt buyer does after that. The third option is legal collections, where you use a legal collections channel to file lawsuits to obtain a judgment against the charged off debt. The legal strategy can be deployed at all stages of the debt cycle, from charge off to late stage debt. It can be a standalone strategy or can be a follow-on strategy to the call and collect strategy. Typically, accounts with a higher outstanding balance and value are better suited for legal treatment. The legal collections market in the US alone is estimated to have a TAM of $1 to $1.5 billion and continues to grow. This acquisition helps us build our capabilities and scale in the debt collection industry. It's firmly in line with our digital first, digital now strategy, and will enhance our platform-based services portfolio. ARSI has developed strong IP in the way it prioritizes the lawsuit filing and has a proprietary platform that partner attorney firms use to manage case volumes. The purchase consideration for this acquisition is expected to be $53 million, of which $46 million was paid at closing, and the balance is payable on the first anniversary of the deal, linked to performance-based earnouts. We are onboarding a very tenured and experienced team, and I'm very excited as we integrate the entity within the wider Firstsource organization. In another development, we are actively evaluating nearshore locations for the US and UK markets to address the structural demand-supply challenges in the onshore markets. We're delighted to report that we opened our first delivery center in Mexico, creating a nearshore option for our US clients, and we will go live with a large health plan in March next month. This has been a challenging year. Couple of macro factors. One, the surprising strength of the household finances, and then the continued impact of public health have dented our original growth expectations in the collections and provider business, respectively. And then while we anticipated that the mortgage refi market would cool this year, the reduction in volumes has been sharper than we had expected. However, we shouldn't lose sight of the progress that we have made building out a foundation that we anticipate will drive consistent top quartile growth in our industry over the longer term. We are focused on our growth framework to 1, maintain a sharp focus on the 3 core industries of banking, healthcare, and CMT. Second, modernize our offerings, particularly investing in our digital first, digital now approach. And third, building a purpose-led, scalable, and agile organization. Quick rejoinder, we made solid progress on these over the last 12 to 8 months. We successfully turned around our HPHS business, including the largest platform-based services deal in our history. Further expanded our domain and digital capabilities with the acquisition of Stonehill and ARSI. Re-engineered and introduced new platform-based services like the mortgage post-close and a few others. greatly strengthened our delivery and account management capabilities. And we recently gained inclusion in the Bloomberg Gender Equality Index, a testament of our efforts to build a holistic and inclusive growth-oriented company. We look forward to speaking to you again in 3 months, and we'll highlight our full year results and provide our expectations and guidance for the next fiscal year. I will now pass over to Dinesh to cover the financial details for Q3.
Thank you, Vipul, and hi everyone. Here is a quick summary of Q3 FY22 financial performance. Revenue for Q3 came in at rupees 14,638 million or $195.4 million in dollar terms. This implies a year-on-year 7.2% in rupee term and 4.9% growth in constant currency terms. On the margin front, operating margin or EBIT came in at rupees 1,762 million or 12% of the revenue for the quarter, which is 10.8% growth year-on-year and is the margin expansion of 39 bips. Profit after tax came in at 1,355 million or 9.3% of the revenue for Q3. This is 11.9% growth year-on-year with a margin expansion of 39 bips. In Q3 FY22, we generated rupees 3,243 million cash from operations. Our free cash flow was 3,059 after adjusting for capex of 184 million. Our closing cash balance as of December 31st was approximately 1,898 million. DSO is slightly higher this quarter, which is at 58 days in compared to 54 days last quarter. We completed 2 acquisitions during the quarter, as Vipul talked about detail about the ARS and Stonehill. These purchase consideration paid for these were around 5,067 million. Both these acquisitions have an earnout payable on first anniversary linked to the performance. Net debt as of December 31st stand at 5,882 million or $79.1 million versus the 3,380 million or 45.5 million as of September 30th. Tax rate for the quarter is slightly low, around 16%, but we expect that for the year it will be range between 16 to 19%. I'm pleased to announce also that board has recommended an interim dividend of rupees 3.5 per share or the 35% for the financial year. Total payable expected on account of this going to be 2,439 million rupees. On our forex hedging, we have coverage of GBP 43.3 million for the next 2 years with rate ranging from 108 to 113 per pound. We have also have coverage of $68 million on with the average rate between 77 to rupees 80 to a dollar. With this, we can open up for the questions.
Thank you very much. We'll now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Participants, you may press star and 1 to ask a question. The first question is from the line of Nagaraj Chandrasekhar from Laburnum Capital Advisors. Please go ahead.
Hi Vipul. Thank you for taking my question. I can understand on the current quarter, but even by the second quarter, our provider business was still 15 to 20% roughly below the pre-COVID run rate of $120 million a year. Why was this so even in the second quarter, despite electives being back to normal in the US? And how does the public health emergency specifically hit us and our eligibility business? I'm asking this because some of the larger RCM players like R1 were talking about procedures being back to normal by the second quarter, 2-3 months ago. So just wanted to understand how we were specifically hit more than the larger RCM players by what has happened.
Sure. Thanks, Nagaraj. So a couple of comments, right? One, relative to public health emergency, I think that's one of the nuance which impacts us. We play on a part of the revenue cycle, or a big part of our business is just the eligibility services, where we get coverage for uncompensated care for our primarily through either Medicaid enrollment or other avenues which might be available. Now there, because of the public health emergency, government is providing a lot of support to hospitals for COVID treatments and others, and there has been almost like a large chunk of population which is compulsorily enrolled in or automatically enrolled in Medicaid because of the public health emergency proclamation. So that has disrupted the normal revenue cycle flows, right? The normal sort of portfolio of what type of clients will come in and what sort of support they would need for our hospital clients. That disruption of the flow has impacted our flow, which is the eligibility services. And our hope was that in Q3 we'll see that support will wane down and normalcy will return to people coming back to hospitals. But with the resurgence of Omicron, again we saw that a lot of hospitals prioritize this COVID care. Consumers also were hesitant sort of coming back, and that ran through most of December and January. Hopefully that kind of starts to die down. But we were expecting growth to come back in Q3 and Q4, and that's what we've seen deferred back because public health emergency is now targeted to go sometime in mid-April. So I think that's the difference between us versus some of the full scope RCM players, which might be doing different scope deals.
Understood. So understood. So just got it. Just does that mean the growth we've seen QOQ on the healthcare side has all been driven by HPHS?
Majority is absolutely coming from HPHS, and provider has had a relatively muted year.
Understood. And just on the BFSI side, we've seen a moderation in margins which were at sort of all-time highs. Is this now a more normalized number, and what really were the drivers of this spiking up over the last few quarters? Was it driven by sort of mortgages numbers, and is the current margin a more normalized margin?
So as volumes in the refinance portion of the business, right, as they have started to tone down as we expected, in fact more than what we expected, we are balancing our costs. So there is a little bit of a time lag between revenue dropping off and full cost action taking, and there'll always be some fixed costs as well. So I think some of it is baked into our Q3 numbers, and some of it will kind of come through in Q4 as well, the moderation in the margin for that. But yeah, we also had, when we were running, when we were enjoying the higher volatile revenues of mortgage, we had a little more SGA leverage on that business as well. So that was partly driving some of the reasons. Collections, again, as we said, we started well in Q1 and then it started dropping. That has an impact on the margins. I think next year when collection volumes come back, that will be a positive sort of a tailwind to the margins for BFS, while mortgage will kind of pull it down a little bit.
Understood. And just finally, what was the absolute mortgages dollar number this quarter? And I see the total origination and refi volume in the US is now settled at roughly 600 billion ballpark the last quarter, if I'm not mistaken. Do you think that is a sort of normalized number, or do you see it having the chances of going to a 300-400 billion combined number like you had in the first half of 2019?
Yeah. So in terms of our revenue, Q3, including for partial quarter for the acquisition, we are closer to about 50 million revenue for Q3 on the mortgage side, right? The market in terms of the volumes, I think it's a very dynamic market. By Fed's own admission, they've taken out the word transitionary from their inflation commentary, and they said that we'll have to watch it carefully and keep the policy nimble. And we're seeing most of our clients also kind of watching it. The purchase market continues to be strong in the US, and that we see that demand is strong. It's more limited by supply. obviously as interest rates have grown, there will be some dampening of demand because of higher interest rates, as 30-year mortgage has already moved up something like 50 basis points from November to now. So I think there will be some dampening, but the purchase market continues to be strong. The refi volume as to what is the equilibrium based on the interest rate, I think that judgment has to come to say what will play out, what will be the volume out there. But I also wanted to caution out that, look, there is a lag between the volumes that are coming there and what is forecasted versus how it plays out in our revenue and forecast, right? So what you saw in Q3, we expect Q4 will be lower as far as refi volumes is concerned.
Thank you. Sorry to interrupt you, Nagaraj. I'll request you to come back in the question queue for a follow-up question. I request to all the participants, please restrict to 2 questions per participant. If time permits, please come back in the question queue. The next question is from the line of Mohit Jain from Anand Rathi. Please go ahead.
Sir, one was I was not clear about the organic growth numbers. So how much contribution have you added for 3Q22 in terms of absolute dollars?
So we said we've done about 5% year on year, of which 4% came from inorganic. So modest 1% year on year came from organic.
So when you say modest 1%, 3Q21 we were closer to 185, 186 million. And this time we have reported 195. So you're saying almost 7-8 million has come from inorganic, which seems to be on the higher side.
So let me just do the math. About 7 to 7.5 has come from inorganic.
And that includes Stonehill
and ARSI.
2 days contribution of ARSI.
No, we actually got more than that because we signed the contracts sort of earlier, so we got more than that revenue in ARSI.
So ARSI is integrated for 1 month, or how should we read it?
ARSI was closer to a month, slightly less than a month, but yeah, closer to a month.
Closer to a month. And the other one, Stonehill Group, is integrated for almost 2 months. Is that correct?
Yes, slightly less than 2 months, but yeah.
1.5. Okay. And sir, from a 4Q perspective, what is our outlook? Because there is a sharp revision, downward revision. There is a revision in the last 2 quarters as well. But where do you think any outlook on 23 would be helpful? Like you guys are bottoming out, or you think there will be some pressure in first half 23 as well, and then you may see recovery towards second half?
Sorry, you're talking about second half in terms of next year? Or second half of the quarter?
Do you expect to sort of bottom out in 4Q, or do you think this will continue in the first half of next year, and then we should actually expect some recovery towards the second half of next year?
Yeah. So Q4, right, if you look at it, obviously you will see an impact. That's why we have brought the full year guidance down to the 14 to 14.5. Taking the full quarter impact of the acquisitions, I think next year, the fourth quarter will be growth over what we saw in Q3, right, because of the impact of these acquisitions. But in terms of the outlook that you asked, I think I mentioned earlier, I think collections is starting to turn around. We're starting to see green shoots of sort of higher volume. Obviously, they won't show up in the revenue for Q4, but I'm cautiously optimistic that it'll start to climb up through Q1 and kind of continue to climb through Q2. The volume recovery that is. Second, provider, again, a little bit of a variable on hopefully Omicron dies away as it's for now tending to be, and there's no reversal of this declining trend. With that, we expect that providers should start to come back to normal, especially if the public health emergency is finally closed down in April. HPHS is continuing strong. Mortgage servicing is continuing strong. Europe is strong. The only variable is definitely Q4 for mortgage refi will be lower. I expect that will continue. The refi will at least be lower in the first half of H1, right before it stabilizes. So when you add all it up, we haven't done the full forecast, but I would expect that next year most businesses will start to trend upwards, barring sort of the refi portion of the mortgage business.
And from the total mortgage standpoint, like you spoke about, I think $50 million as the revenue for 3Q. You are obviously expecting a sharp decline next quarter. Where do you sort of expect it to settle down?
At this point in time, the way we have kind of modeled out, actually I should say, without acquisitions, mortgage is about 50 million for the quarter.
50 million is without acquisition, is that what you're saying?
Without the acquisition.
Without the acquisition, okay.
Without the acquisition, right? Now, as we go to Q4 and then we have the full impact of the acquisition, we expect at this time we're modeling about 45-46 million, including acquisition.
And then steady from there till the time you see some recovery.
We will see some softness from there on as we go into next fiscal because of refi volumes, right? So we'll see some softening from that level as well.
Understood, sir. Thank you, sir. That's all actually from my side.
Thank you. Participants, you may press star and 1 to ask a question. The next question is from the line of Dipesh Mehta from Emkay Global Financial Service. Please go ahead.
Yeah, thanks for the opportunity. Just want to get sense about the organic business. I think you partly answered 7.5 million is acquisition. So in a way, you are implying this quarter we have a sizable sequential decline, and probably even YOY we might be down or might be hardly any growth. And so if you can help us understand now mortgage business, if one look at it, mortgage business is not explaining full weakness. And obviously we know some of the factors which are not doing well, but surprisingly there are not sufficient factors which are negating that impact. If you can help us understand structurally what measures you are taking, which can negate some of the headwind, right? In business, you have in any given period you have some headwind, you have some tailwind.
Yeah.
But for us, negatives are outweighing positives. So if you can help us, what steps you are taking which can give sustainable growth over medium term?
Yeah. No, great question, Dipesh. So look, as I look at our portfolio, right, if I just step back and look at our portfolio of the 5 large operating businesses, this year, HPHS had a strong year, CMT had a strong year. Europe, which partly overlaps with CMT, had a decent year, right? There were some staffing issues, etc., which kind of, took away some of the revenue opportunities. But collections was impacted with very unique economic environment, provider because of continued COVID. And then mortgage we expected, but it's gone a little bit worse than we anticipated because of how the markets moved and how inflation's come up, in the U.S. economy. So effectively, two of the businesses were buffeted or faced macro headwinds, which I think will play out, which should ease out next year, right? Both for collections and provider. Organically, in terms of our effort, the stuff we're doing is that we have invested, we've taken the time for our provider business to strengthen our offerings, strengthen our teams on sales and account management. And we've integrated patient matters into a better platform. And I think as markets come back, we have a more broader offering which covers the entire patient payment experience, as opposed to just we were doing chunks of collections and chunks of eligibility. Now we'll do the patient experience. So I think provider, we have done a lot of work to kind of make sure that we have a broader offering and a more strengthened team as the market comes back. As far as collections is concerned, I think the acquisition of ARSI, tremendous capability on the complementary side. Today we just did one part, which is the early stage. Now we can do the third leg of the value chain, which is legal collection. And we do intend to take this broader capability to a broader customer set beyond the credit card segment, into fintechs, into utilities as well. And we are also actively deploying some investment into UK to take the collection capability out of US and take it to the UK market. Again, early days, right? To kind of keep there. That's on the collection side of it. Keeping on with the CMT focus that I've been talking to you about, I think it's been a complete organic build, coming cold into the market from a standing start. while revenue-wise it's taking time, but I'm very encouraged by the kind of logos and the kind of work we're signing up, and I think that will start to kind of gather momentum into next year. And that will be all net new growth, given the new growth sector, the fast-growing sector has a very small revenue base into this year. Whatever we get next year, majority of it will be net new growth. And then lastly, on mortgage, the Stonehill acquisition is almost 2/3 or more than that is towards servicing. So it kind of strengthens our servicing portfolio. So while we'll deal with the volatility of the refinance market, I think we continue to focus on the service portfolio so that we kind of continue to have a more stable revenue mix, as well as that share increases as far as overall mortgage is concerned. So those are some of the specifics in terms of actions across the businesses so that we can somewhat limit the or better deal with the macro impact that we saw in 22.
So let me ask it differently, Vipul. I think year back or year and a half back, you always used to say business, considering overall portfolio, we can deliver low to mid-teen growth on sustainable basis, on organic basis. That is what you expected business to deliver. FY22 seems to be a weak year, but considering all these puts and takes, how far we are from delivering those kind of number on organic basis?
Well, Dipesh, if you look at it, it's a fair question, but now that I'm guiding to 14 to 14.5, we're still looking at between 10 to 10.5% organic growth to come this year, despite the significant sort of headwinds that we've had. So to that extent, if you think about it, last year you guys had asked us and challenged us that FY21, a lot of the majority growth came from mortgage. This year, if you look at it, mortgage had pretty small growth, right? Low single-digit growth on a net year-on-year basis, although run rate will be lower. So all the organic growth that you're seeing has come from the investments that we put in 21 into healthcare and CMT and stuff. And I think that robustness will continue to show into next year as the volatile revenue plays itself out, and it's a more stable and sustainable revenue which comes into play.
Sorry to interrupt people, but if I do adjustment for mortgage business from exit FY21 to now, you have significant headwind entering into FY23. 22 because we are saved because our exit rate was very high in mortgage. Once we exit FY22, we have significant headwind to get that double-digit organic growth, and that's why I asked this question. So again, we are going through a robust budgeting process. I don't have the numbers yet to give you for the next year growth. I'm giving you direction and qualitative answers from how the numbers are playing out, right? I think the foundation for the business is solid in sort of 4 of the 5. It's the mortgage volatility which is kind of creating some noise, but otherwise the businesses are all on a sound footing. Once you kind of pause and look at the math, you can see what the organic will come out to be. Fair point. Can you give me a couple of data points? What would be the servicing mix or servicing revenue this quarter out of mortgage 53 million, which you said including acquisition?
This quarter, the servicing is closer to 40%.
Okay, and the split between provider and payer?
It is, it's closer to, it's half and half, with maybe HPHS being slightly higher than 50%.
Understand. Thank you.
Thank you. The next question is from the line of Manoj Baheti from Carlin Asset Advisors. Please go ahead. Manoj Baheti, may I request to unmute your line from your side and go ahead with your question, please?
Yeah, sorry, I was on mute. Good afternoon, Vipul. Good afternoon, Dinesh. So, I have a couple of questions. First one is, if I look at the head count, the headcount is going down, and that is something like maybe due to attrition. But if the headcount starts going down, especially in your business, are you factoring in a lower growth momentum, or it is because of higher efficiency or higher digital enabled solutions or services which you are providing? How do we read this number?
Hi, Manoj. So clearly, as we talked about, right, as some of the volumes have declined, this quarter on mortgage and last 2 quarters, we've been seeing softness in collections business. You know, we've kind of managed our headcount, right, as attrition has happened. We've not refreshed some of the positions, right, to make sure our headcount was in line in this. So I think it reflects that majority. But yes, ongoing basis, there is a lot of effort at automation, both in terms of what we contractually commit to our clients as well as for our internal efficiency. Also keep in mind that the acquisitions that we've done, although they had a small impact in the 3rd quarter, more in Q4, they're both have platform-based services at the core, right? So their revenue runs on a different trajectory than our business. They're both majority of the business on an outcome basis and delivered through platforms. So they have a different revenue to headcount sort of dynamic compared to rest of our business. And that will also have a positive impact on the revenue to headcount relation on overall, as those are fully integrated in Q4 in our results.
So this headcount number is inclusive of your acquisitions, the manpower which you acquired, or X of that?
Inclusive.
It is inclusive. So organic wise, it is much bigger drop, right?
Dinesh, this is inclusive, right? The headcount?
Yeah, it's inclusive. That's right.
It is inclusive, yes.
Yeah.
Okay, so on an organic basis, is it much bigger drop than this number?
We've added slightly less than 400 people through these 2 acquisitions.
Okay. And my second question is, like, if I have to see mortgages business from a medium-term perspective, especially looking at the way the U.S. macro will unfold, interest rate starts going up. I don't know whether delinquencies on credit card will again go up with the rising spend. And also in terms of your refinancing business, like, which will have a structural headwind at least for next 1 or 2 years at least. So how you are going to mitigate these kind of headwinds, especially on mortgages business, which is a large proportion of your revenues, as well as I think on the base side also it is having a good growth. So if you can answer this question.
Yeah. So I think two parts to your question. When you talked about the impact on the credit card, right? So clearly, as spend rises, right, as people step out and start to do discretionary spend on credit card, and which is essentially an unsecured loan, and with inflation starting to kind of impact household finances, delinquencies rate will rise, right? Right now they are way off the normal delinquency or historical delinquency rate, but they will rise, and we're starting to see that. And in normal economic environment, there is a natural, somewhat of a hedge between our collections and mortgage business, right? 22 was a very unique year where both kind of went in one direction of sorts, right? So next year, I think they'll return to some element of natural hedge between the mortgage and collection business. That's just one comment. The second comment on the mortgage side, yes, as interest rates rise, refinance economics change for average home buyers, right? They go for a refinance when it makes sense, it's interest low, they save some dollars and they go for a refi thing. But when interest rates go high, there is no incentive for them to seek a refinance, right? Then you're down to sort of the normal purchase transactions, or there will always be a population of home buyers who've had historically higher rates or whose credits improve, and then they're eligible for lower rates and they come in for refi, right? So there is that core refi, there is core purchase, and then there is the volatile or the more opportunistic refi buyer who comes in because there is an interest arbitrage opportunity for them. I think the third portion is what is dropping off now, right? And they all repeat this cycle 3 to 5 years, right? As interest go up, right? So we are sort of starting the the end of that cycle. Whether it takes 3 months, 6 months, 9 months to work its way through the system, we'll kind of see. But I think there is a core element to our mortgage business, the servicing as well as the core volumes of refi, which is strong. With the acquisition of Stonehill, we are adding 2 new lines, quality control and due diligence. Due diligence especially plays in the secondary market purchases, which is unlinked to what's happening in the core market, and especially with the MBS purchase lower by Federal Reserve, the secondary market activity increases, right? More investors buy pools of loans and they need due diligence services on them and they need QC services on them. So I think that was the whole reason we also were keen on that acquisition, to make sure we are building foils for additional growth lines there. And I think so servicing, more efficient refi or more efficient financing, and then QC and due diligence are the building blocks for now for us. And second, clients still are doing a reasonable amount of financing and refinancing with them. As we kind of push more efficient solutions, after this initial shock of capacity wears off, clients have to look for lower cost options. And I think that's where offshore and digital comes into play, that you become an answer for your clients in a declining market more. So I think those are the factors which we think will help us buffet some of the declines that we are seeing this quarter and potentially going into next year as well.
Sure. And lastly, on ARSI, if you can give some more color in terms of some quality parameters of the target, where are you seeing the potential? Where are they right now in terms of revenues, profitability, and how do you see that it is going to unfold over next couple of years?
Sure. So look, it was a founder-led company, right? They had a good portfolio. 2 of their largest clients overlap with us, right? We also serve them. We serve the early collection need. These guys serve the legal collection needs for 2 of the largest banks in the US. So that's a good synergy for us to kind of combine. They had a decent go-to-market, but I think it was, from our standpoint, the way we would run our business, we will increase the investment in the go-to-market and extend the sales and the account teams. We want to take them to our clients, and we want to push hard on the fintech side as fintechs become more influential players in the lending and in the lending side of the market. I think giving them holistic collection solutions, both early stage or call and collect or legal stage, legal collection option, that's one of our strategies. And then obviously when we marry our digital collections with their abilities, we need to play out. But our thesis is that low balance debt, which is typically, let's say, utilities or BNPL, if we can do legal collections with a very strong digital intent, it brings down the threshold of what debt you can chase, right? Then it makes a little bit more economic sense to do for lower debt, right, as well, because you're able to do digitally. So I think there is potential to grow that business, expand it into other parts of the banking chain, and maybe take to other industries. Margin-wise, they are slightly lower, somewhat lower than our target margins. We kind of know that. And we think as we get there, as more scale comes in, as we put in a little bit more technology and more leadership discipline on cost management, over the next 4 to 6 quarters, we'll kind of bring them on parity to our margins. All of that is kind of baked in how we evaluated this business. So I think that's how we're kind of looking at that business.
Thank you. Sorry to interrupt you, Manoj. I'll request you to come back in the question queue for a follow-up question. A request to all the participants, please restrict to 2 questions per participant. The next question is from the line of Mihir Manohar from Carnelian Asset Advisors. Please go ahead.
Yeah, hi. Thanks for taking my question. I wanted to understand
sorry to interrupt you. You're sounding very distant from the phone. May I request you to speak through the handset?
Yeah, sure. Is it audible now?
Yes, thank you.
Yeah, sure. So, I wanted to understand the split between refinancing, origination, and collections. So, among the BFSI domain, what is the split in these 3 categories: refinancing, origination, and collections?
So I think there are 3 parts to our banking and financial services business, right? There is the mortgage business, which in turn is made up of origination and servicing. right? Which we said is like a 60-40 split between them. Then there is collections, which is largely a US business today, as is the mortgage, as we call it. And then there is a Europe banking and financial services business where we serve retail and commercial banks. Those three combined are our BFS business. So in that context, can you ask a question again, please?
Yeah, sure, understood. So I just wanted to get the split on that. And I mean, broadly among these three divisions, which divisions has higher margins?
Which division has higher margins? I think both mortgage and collections generally run at the same margin levels. Europe, our margins somewhat lower because of the higher onshore component of that business, right? And it's pretty much majority DEC business or digital empowered contact center. Europe tends to be somewhat lower, but mortgage and collections are generally in parity.
Okay, yeah, understood. And just one last clarification. So I think you lowered the last time you had guided for 14.5 to 15.5, and that was including the acquisition of Stonehill. But this time the guidance that you have given also includes the acquisition of ARSI, right? So last time, so the clarification that I want is last time the guidance that you had given was without the acquisition of ARSI, right? Is that understanding correct?
Correct. At that time we hadn't closed the deal. We were still in the due diligence phase of that. Yeah.
Okay, and that is still, I mean, close to 10% of our the size of that company is close to 10% of our revenue. So in that context, the downward revision guidance is even more than what a downward revision was there in 2Q, right?
Correct. So at that time we had given including one, but yes, we have downward revised now the organic guidance to about 10 to 10.5, and then about 4% will come from these two guys combined for the quarter, baked into the full year guidance.
Understood, sure. And the start of the guidance that you had given at the start of the year was without any inorganic component, correct?
Largely, yes.
Understood. Yeah. That's it from my side. Thank you.
All right. Thank you.
Thank you. The next question is from the line of Shraddha from Asian Market Securities. Please go ahead.
Yeah, hi. Thanks for taking my question. One clarification. This mortgage business, the run rate of 50 million.
Shraddha, your voice is somewhat unclear. Neerav, can you hear her clearly?
Is it better now?
Yes, sir.
Yes. Yeah.
Yeah. So this mortgage business run rate of $50 million, is it with or without acquisition this time? Just one clarification here.
The 50 million that I mentioned to you for this quarter is without the acquisition.
Okay. And Vipul, you mentioned that Stonehill was consolidated for 2 months, right? Broadly 2 months, less than 2 months. But when I see the BSE filings, I see that the acquisition got completed only in the month of December. And the ARSI acquisition got consolidated in the last week of December. And there again, you're saying that the numbers are consolidated for broadly a month. So just wanted to check how is that possible when the acquisitions got closed late. So how are we accruing for a higher duration for both these acquisitions?
So I think as per the accounting terms, we required to go through the agreement which we have signed with those guys. So Stonehill, we have agreed on 9th November, we have closed the deal. There are some administrative things needs to be closed, which was the pending. So from the control point of view, we have started getting control from that point. And as per the agreement, all the profitability and everything accrue to the Firstsource. And the same applies to ARSI also, because we were in discussion. There are things which is got pending due to the Christmas holidays on all of those. But I think from the promoter angle point of view, we have did close. Accounting suggested that practical purposes you need to take when you have a control of those assets. And that's the reason we accounted at these months.
Okay, fair enough. And secondly, ARSI had revenue of close to $72 million. That was the last year revenue reported for them. And we did indicate that we have some, client commonality in the sense that 2 of their largest clients overlap with us. So do you think we can expect this entire $72 million to get added to our top line, or will there be some, some let-off because of some client commonality?
Not because of client commonality, because we do completely different things for the same client. But, there is the collection softness that we see in our business in FY22, because they come later in the default cycle, right? We will see the softness of collections in terms of lesser volumes which flew into the delinquent bucket in 22 will reflect in some softness in the ARSI business for next year in FY23, because that's how the cycle works. They're sitting on a large portfolio, right? So that kind of buffers it, but there'll be some softness from FY22 flowing into FY23, and then it'll come back up again. So there'll be, from the 72 that you mentioned, we expect there'll be some downturn, and obviously there'll be some element of goes down when you do an acquisition for a founder-led company. There'll be some softness in a few relationships, which we have baked in, right, going into next year.
So would it be possible for you to quantify what should be the reasonable revenue to be built in for ARSI for next year?
We are working through the details, right? When we come and talk to you for the next quarter, when you give guidance, we'll try to kind of isolate that out.
Right, sure. And Vipul, just on the large HPHS deal that we signed last quarter, how is the ramp-up going on? And, is it broadly on track? And do we expect good revenue accretion to flow from this deal in Q4?
Yes, it's on track, right? All the milestones as we had agreed with the client and our IT services partner are on track. We have done, there was a small portion of rebatch that we had to do. That's happened on the milestone, and the first batch of knowledge transfer is on track. So yes, we expect Q1 revenues to come in, Q4, Q1 calendar, Q4 fiscal revenues to be on track from that deal.
Right. So $15-16 million is the kind of annual run rate that we were talking of. So broadly, that would be the run rate, right?
50-odd million, yeah.
Yeah. Okay. Thank you. That's it.
Thank you.
Thank you. The next question is from the line of Rahul Jain from Dolat Capital. Please go ahead.
Yeah, hi. Thank you for the opportunity. Basically, I have a question regarding some perspective if we could share for FY23, because if we factor in the guidance that you have suggested for this year, we may have the run rate of close to 200 to 205 on Q4 basis. But based on various comments that you have shared for FY23, we may see some downtick on the numbers that we will have for RC going into FY23. Also for the mortgage business in general, we expect collection and provider business to improve only ideally by Q1, which can also see some kind of delay because that's just an anticipation at this point. So with so many headwinds and no real kind of a trigger driver for the revenue stream in FY23, what kind of a growth band or range one should kind of put into FY23 with multiple headwinds coming into play?
Rahul, I think you've captured some of the things that I've commented on. I think ARSI will not be any significant, but I was just giving a sense that it won't be an uptick right away. There'll be some downtick before it comes back. And also, I'm not sure I would agree to say there are multiple headwinds. I think mortgage is one headwind. Mortgage refi is one headwind that we have to grapple through as we get to into next year. But all other businesses, right, both collections and provider, which have been impacted this year, I think it should start to ease off. Collections definitely starting to ease off already. Provider still kind of on the fence, depending on how Omicron kind of downplays. But I think in general, the foundation for that business is strong. And, there was earlier comments of some of the other players who have broader offerings. They're starting to see normalcy back. I think we'll see that as well, albeit with a little bit of a lag. And I think HPHS in a strong wicket, we'll see some of the wins that they've done, the benefits will come through. as well as UK, right? Our UK business is working on a decent pipeline. I think that will have a good solid year next year as well. So I would not, in my head, I don't characterize as multiple headwinds. I characterize as sort of one headwind, and the rest, right? We obviously faced the brunt of it in Q4, and I think it'll reverse and sort of ease off as we go into the next fiscal. In terms of actual growth guidance, I'm very conscious of that we need to come and give you credible guidance. So I don't want to sort of hazard a speculation yet until I've gone through a proper budget and kind of tested it, a couple of ways before I come back and give you the growth guidance.
Right. So maybe I need to put this in a different manner. So first thing is that the allocations on the inorganic side are coming in an area which we know that at least near-term perspective are not going to be an attractive asset. Of course, the valuation are also very attractive at which we might have done this transaction, which also suggests that the run rate is expected to go down. So of course, this is a definite positive from a very long-term perspective, but that is one thing which I found little, not very ideal, given that we are also dealing with the revenue deceleration, so as to call it, looking at the number what we delivered in FY21. And secondly, from the perspective that provider also, like I think right from the beginning of the year, we were very hopeful about that this could be a driver for the business, but which has not played out. And none of us have any control about from a virus perspective. So giving those things in mind, you think the current year organic growth of 10.5%, which you said, is something what we can have into next year or higher, or you can say it's too early to even gauge any number related to that as well?
Yeah, again, as I said, right, we need some more time. As we come to Q4, we'll kind of come and talk about the guidance for next year in terms of growth percentages. Just to kind of a little rejoinder on your point, I think you captured well. I think these are good valued acquisitions. I think legal collections is a little bit of a fragmented market, and I think there's an opportunity for us to come in and apply the scale of a well-run enterprise and kind of make inroads into that market. So I think, notwithstanding the unique collections environment, right, of robust household finances causing low delinquencies, so it will have some impact, but overall, I think not long term, but sort of I would say short to medium term, it's a good business. And likewise, mortgage, as I mentioned, Stonehill plays in a market segment which is not as directly correlated to refinance, right? QC somewhat is, but due diligence is completely unrelated, and QC is also done for more complex either purchase transactions or more what is called as non-conventional or jumbo transactions, right? So it's not as correlated to the refinance or interest rate sensitivity. So I think both these are good additions to our repertoire that we have added adjacent capabilities allow us to get growth. I just wanted to correct that perception that we bought in the segments which haven't done well. I think we baked that in, and I think this kind of helps us kind of add new capabilities even in those segments. So that's how we look at it rather than just a pure value buy.
Yeah, I appreciated the color. Just if I mind, just to ensure my understanding, can we say that now, because the kind of a portfolio that we have around in the mortgage, in a normalized scenario, let's say beyond FY23, now the kind of portfolio we have, irrespective of the cycle of the mortgage, we should be able to have some growth on a sustainable basis, or you think it still will have volatility, but lesser volatility given the portfolio that we have?
100% the latter part, Rahul. I think as this, we enjoyed this volatile revenue, right, for the last 18 odd months, right? It will play out, but the core of the finance volumes and servicing and what we are adding, I think this is a very solid portfolio. And, once this, especially when you look at beyond FY23, we absolutely have to look at it as a growth portfolio.
Perfect. Thank you. That's it from us.
Thank you.
Thank you. The next question is from the line of Dipesh Mehta from Emkay Global. Please go ahead.
Yeah, thanks. Just one clarification. You indicated mortgage revenue to be around 45-46 million next quarter. That is including acquisition or ex-acquisition?
Including acquisition.
So in a way, you are implying roughly 30% decline in origination business on sequential basis.
Your math is way ahead of me. Ankur, can you help me on this?
Servicing business is a stable business.
Yeah. So, okay. If you take from that perspective, Dipesh, yes, if servicing is stable, the original will drop about 30%, right?
So 30% is in origination business. And if I compare that with your historical, so we are back to a Q4 FY20 kind of run rate, from where we have seen significant uptick in our revenue. So from that context, now we have signed some agreement with one of the anchor client, and where SourcePoint made some equity related payment and other things. Now any conditionality change to that thing, where, because I think in future performance also it was linked to some kind of equity related payments. So if you can provide some sense about how economics works for those relationships.
So so those relationships, as we had said, right, there were two parts to it. Bulk of the payment was pertaining to sort of what was historical, right, going back to the 2018 agreement, right? So almost 4 years of kind of playing into that. As we go into the future, there is a variability to the payment that we had given, which is linked to certain spend levels which are lower, significantly lower than the historical levels. So as long as we get that base revenue, right, the variable portion of the payment will be paid, otherwise it won't be paid.
Any sense you can provide us, because that number will be there in the, I'm not sure, FY22 number, or it will come only in 23 now?
FY23 now. It will come in FY23.
Okay. And last question is on the collection business. Can you help us understand collection business run rate?
Collection business run rate?
Organic revenue run rate. Because if I look your non-mortgage BFS revenue, and if I adjust for the run rate of the acquisition, it seems to be very weak. And that's why I just want to get sense what explains that weakness.
So look, collections, I had told you in Q2 that is going through a historically low volume period, right? And it's been a very soft year compared to what our growth expectations were for that business. So Q3 December quarter, if I look at collection business without acquisitions, we would be on the run rate of somewhere between 15.5 to 16, I think.
Roughly 60 million.
Is that Ankur, that's right, correct?
That's right, Vipul.
Yeah.
No, so Vipul, then the weakness appears to be in UK BFS. Can you help us understand what is, why the weakness in UK BFS? Because it is generally stable business.
Very small weakness. It wasn't anything material or any major factor there, Dipesh. Primarily due to the talent situation that we had talked about, plus the higher absenteeism, which meant some revenue loss. There was just minor weakness minor impact.
Yeah, you said that thing for CMT as well as UK BFS. How that situation, whether it is returning to normalcy or yet situation is still dicey?
I think it's better now as we come into the second part of January, as UK and US both have started declining numbers. We're starting to see the shrinkage factor, as we call it, that has started to come down.
So Q4 should have be relatively better performance from those parameter perspective.
Correct.
Understand. Thank you.
Thank you very much. As there are no further questions, I now hand the conference over to the management for closing comments.
All right. Again, thank you everyone for joining. Thank you for your continued engagement and great questions. Again, as I said, somewhat disappointing quarter and the guidance, but I remain very confident that we have the right foundations, and we welcome your questions and engagement with us, and we'll come back and talk to you in another 3 months. Thank you.
Thank you very much. On behalf of Firstsource Solutions Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines. Thank you.